OneMain Holding or OMF stock, it's up 301% in the last 10 years with dividends reinvested, and just on the share price it's up 220%, which beats S&P 500. If you invested in this company 10 years ago, you would be sitting on a really nice return. They're paying 8% dividend, give or take, and that's forward dividend. They just announced a 4% dividend increase going forward, and they've raised their dividend by 300% over the last 10 years. Okay, so the stock is doing great. Over the last year alone, it's up like 45%. If you look at the share price right here, so a year ago was below $36. Today it's around 51. So the stock is doing great, and the company is making money. And the question is it a good time to invest in OMF or not? And if it's not, what's a better time? So let's take a look at this company. Let's look at their earnings and make a deeper dive than usual. So right off the bat, I am an investor in this company. I've been in it for a few years, collected a lot of dividends. The stock is pretty volatile, so you can sell cover call options and collect a lot of premium using that method on top of the dividends. And so that's what I've been doing. My returns on this company are amazing. However, I think right now is not a good time to buy the stock, and I'll tell you why while we're taking a deep look at the company. So here is their dividend chart. So over here you see this really tall bars. So there were special dividends, not regular dividends, but now they've switched to regular dividends model. And for a while, like, you never know when they might have a special dividend. I am hoping they'll have one because I'll be getting that. But anyway, so right now their last dividend was $1, and this here shows you the dividend yield curve as well as the dividend amount. Now, because it shows dividend yield, it actually takes into account a price of the stock. So right now it doesn't show the future dividends. That hasn't happened yet. However, if you scroll down, here's the next dividend that will take place in a few days. Okay, it was the ex-dividend date on this is May 9th. Okay, and they'll pay it out if we scroll down. So the payment date will be May 17th, so like a week from now. Okay, so I'll be getting some of that. I had some cover calls on this, so I was assigned right before the ex-dividend date because it was a dividend play. So I missed out on one of those dividends, but my other shares, I also have open cover calls on them, but they're way out in the future, so I'm not worried about that. Anyway, so let's take a look at the company performance. So here we have their EPS for the last quarter as well as price to earnings curve. So you can see PE ratio is going up on this company, partially because their EPS is going down while the price is going up. So that increases the price to earnings ratio. You can see the PE is going up while the EPS is going down. And that's not a very good sign. On the other hand, their free cash flow is fairly stable. And this is free cash flow together with stock-based compensation, which is very small. So that's a good sign. They're not diluting shareholders. In fact, they're buying back shares. So that's also good. Now, here is their EPS versus free cash flow. And their free cash flow is rising steadily, not tremendously. It's not a hockey stick, but it's rising. However, the EPS is not doing so great. So free cash flow per share, and EPS, those are two metrics that management can play with. You need to take a real deep look into their earnings, which we'll do right now. Okay, so this is their cash and debt. I don't like seeing that their cash pile basically decreased by 50%, by more than $1 billion, almost 50% in one quarter. So that's not good. However, it's happening, and it is, it's actually toward the lower end of their typical cash pile. It's a good thing to see their debt also going down, but not as much, only $300 million. So they reported revenue, which was the highest ever. However, the revenue is, because the revenue is people repaying their credit card and loan balances. So it's the revenue is not a great measurement for this company. So this huge revenue increase, it's not as important. So anyway, what does OneMain do? Okay, so they do credit cards and they do personal loans and other loans. You can see here on their website. Their target audience is actually people with lower credit score. And so this way they can charge a very high interest rate on their loans. However, with that comes a great risk of people just not paying back their loans and their credit cards. And so it is actually a pretty big problem for them. And so let's take a look at their, so there's an investor presentation right here. We will take a look at it. But let's first take a look at this like earnings release. Okay, so $1.29 EPS, and they're paying $1.04 dividend. So it's pushing into like uncomfortable territory of earnings to dividend ratio or payout ratio. Okay, so they say that consumer and insurance segment EPS was $1.45. However, we gotta use the regular EPS for that. All right, managed receivables 22 billion. That's great, and it's actually also going. So this is how much money they're actually loaning out, and it's been declining. But we'll take a deeper look at that later. So they increased the dividend by 4%. Usually they've been increasing the dividend every year, but they took us a pause. And so you can see 1, 2, 3, 4, 5 quarters. They've kept $1. So they paused for 1 month, for 1 quarter, and now they increased it. Over here, the dividend increase was huge. It stayed at 95 cents per year, then 5 quarters at $1. Now it's up. Shares outstanding decreasing, so that's a good sign. Over here, it actually increased by 100,000 shares. I'm not sure why. Maybe they diluted a little bit. So stock-based compensation, there you go, 11 million. So they've used their stock as a method of paying their, probably management. I don't think they pay their employees with stock. Okay, they don't have any capex, although they do have branches, local branches. So I guess they're not opening new ones, so there's no capex. There are definitely other expenses, but we'll look at that. Okay, they've repurchased 5 million worth of stock, 109,000 for 5 million. So that's about $45-46 per share. So that's good. It's way below. It's like 10% below current price. However, it's higher than it was a year ago, much higher. All right. So what I don't like in this report is here, net charge-offs in the last quarter were 5.6%, which is much higher than a quarter before that. On December 31st, it was only 7.7, and a year ago it was 7.72, and so now it's 5.6, 5.58. I mean 8.58. So it is not a very good sign going forward, because we know that interest rates are not going down. The Fed is playing with the idea of dropping interest rates, but you know, they tease, but I think it's not going to happen anytime soon. Maybe right before the elections to help Biden to win, but I don't know. Maybe not. I don't know how politically motivated Jerome Powell is, and how much pressure. I mean, they're definitely putting a lot of pressure on him from Washington D.C., from the White House, to lower interest rates. But I don't know if he will give in. Anyway, so it's not a good sign. The inflation is still pretty hot, and even though like technically the official inflation is going down, guys, it's going down from a year ago when it was like 10%. And this is the official inflation. They play with the numbers, so it's not really 3-point-something%. I mean, the real inflation is much higher, and people know that, and that's why you see net charge-offs going up. People just can't afford to pay their loans. Like, for example, if you look at Nobody Special on YouTube, so he said basically last month in April, the mortgage refinance was up significantly, ticked up significantly into very high interest rates. So basically it's people with like 3% mortgages refinancing into 7.5% mortgages. Who in the right mind would do that? And the answer is people who can't afford to pay their current bills, so they're using their homes because the home values are still elevated, and they're above water, and they have equity in their home, so they're refinancing into 7% mortgages just to cover the bills that are much higher. So the credit card's probably like 30%. So it is cheaper to use a 7% mortgage versus 30% credit cards. However, the credit card might be like $10,000-$20,000, you know, at 30%. So that's a lot. 10 grand, that's $3,000 a year. However, if you refinance a $400,000 mortgage at 7%, I think you're actually paying a lot more in the mortgage fees, in the mortgage interest, than like you're saving on credit cards. So I don't know, guys. I think it's and it just shows that, you know, economy is not so strong and resilient as they say. So let's look at their delinquency and net charge-off trends. So you can see the last quarter, their delinquency rates are, for the most part, going down. Okay, so right here, the 31 to 3 months delinquency is down significantly. Then 30 plus days down also significantly, more than 10%, and a slight decrease in 90-day plus delinquencies. So that's great. However, you gotta look here, 8.6% net charge-off. So maybe those delinquencies are actually going down because they just write them off, and you know, it's a complete loss. So this is a significant increase, almost 10% from the previous quarter. And guys, it's like it's pretty much like 20% from a year ago quarter. This is not a very good trend. And if you look here, so this is how much they put aside for loss reserves. Okay, they have $2.5 billion in loss reserves. So yes, it went down a little bit from the previous quarter, but it's almost 10% up from a year ago, and that's a lot of money they put aside, for reserves in case people stop paying altogether, completely stop paying. So that's not a very good sign. So here is their income table, and you can see 155 million in last quarter versus 179 million from a quarter a year ago, and also 191 million previous quarter. So Q1 is usually the lowest, okay, because people basically like run up their credit cards before holidays. So in the third and fourth quarter, and then in January people are waiting for their tax returns, so they're not spending as much, therefore the income is lower. However, they reported a revenue that's like super high, so I think we should take a deeper look at that in the future. It's not really important for this video, but overall the trends are not amazing, guys. The delinquencies are way up. Well, delinquencies are not, but net charge-offs are. So they show decline in delinquencies, however the net charge-off is up 10% from the previous quarter. So they basically lost like $37 million. They just wrote it off as, they will never collect it. So that's not very good. And their provision for delinquencies is very high, $2.5 billion. So they're thinking, if people stop paying, we set aside this $2.5 billion just to cover people not paying their bills. Okay, and the interest rates are going to remain elevated, so it's hard for people to pay. Anyway, am I saying this company is doomed? No. I mean, the company has been performing well. Unfortunately, it's not. The company did not exist before 2008 financial crisis, so we don't really know how they will do during a big recession. The company IPO'd in 2013. So I think if we have a massive recession, the stock will go down below $30. I mean, look, over here it was like 27, and we didn't have a massive recession. In fact, I think the GDP this quarter over here, Q3 of 22, I think they said the GDP grew. So technically we didn't have a recession, and the stock was at 28. Now this COVID, yeah, I mean, everything went down during COVID. Anyway, so basically the stock is up 45% in 1 year, and the dividend yield actually decreased tremendously. So from over here it was like up to 15% if you bought at around $30 some. Now it's a measly 8%. So my thoughts on this company, I don't think this company will disappear. I don't think it's really in danger of bankruptcy. It is on the risky side of a spectrum because they are dealing with people with subprime credit, so 660 and below. Mostly, that's most of their customers. They have starter credit cards for like young people, students, whatever. But most of their business comes from other loans and credit cards for people that have hard time paying their bills. And maybe Biden says that the economy is strong and resilient, but a lot of people are feeling the pain. So buying this company at $51, I think, is not a very good investment decision right now. However, look at the share price of this company. Let's look at the share price. It's all over the place. Let's look at last 5 years and ignore this COVID. It's up, down, up, down, up, down, down, up. So just 6 months ago, it was at below $36. And at some point, I think it went below 35. So would I buy it right now? Absolutely not. I think it's way overpriced. You can see these huge spikes and then drops. And if you look at the 10-year, even over here before like the COVID and all when the economy was booming, when interest rates were like 2%, 3%, look, it goes regularly from $20 to $30, back to $20, back to $30, back to $20, even below, and then it's rising. So it's a very volatile stock. Therefore, I think this price here is not going to hold for long, and I think it's going down below $40 at some point soon. 3 to 6 months. I expect the price to be below $40, and that's when I'm going to start slowly reaccumulating. My target for this company is like $36, $35. That's when I'm gonna start getting back into it in terms of like I was just assigned on my shares, and so therefore and my call options were actually below the current price. So people who bought those calls, or they made money, and they also collected the dividend, so good for them. I also didn't lose out on it because I was buying here and I was buying here, And I was buying actually a little bit over here also. I think I started buying at around $49. However, my current average is like below $30. I think with covered calls and dividends that I've collected, it's like 25 probably. Anyway, so yeah, it's a great company to own long term. I don't think it's going to go bankrupt. However, I think the current price is way elevated. So I would wait for a better entry point on this company. By the way, important metric we overlooked was their payout ratio, which you can see it's steadily going up. That means their dividend and their net income are getting closer together. So their dividend is slowly approaching their net income, and that's very uncomfortable. So over here was actually above. So they made this quarter here, Q2 of 23, their net income was actually below below their dividend, and that's not a very good sign. You probably want this to remain around 60%, and I don't think that will happen anytime soon. They just increased the dividend, and I don't see how they will make more money. If we go back to this presentation, they actually right here. So loan origination, you see it's the lowest in the last 6 quarters. So yeah, there's just not enough people are getting new credit cards and new loans from them. So that means less income. I would say next quarter is going to be lower than $1.29 they reported this quarter. So this ratio right here will keep climbing. However, their free cash flow to dividend ratio is actually pretty safe. Now, again, they report free cash flow for like 600 million. And this free cash flow, it's basically it includes the credit loss provisions. So when you subtract that, that's when you get to 155 million net income right here. No, this is per share. Right here, 155 million versus 558. So they put aside $400 million for credit provisions, credit loss provisions. So based on the dividend, on free cash flow to dividend ratio, it's a very safe company. But you know, there's a chance they will never see that credit loss provision. So in this case, I would actually go with the payout ratio, and it's approaching uncomfortable territory of like 80%. So yeah, at the very least, I would wait for a better price. However, like the good thing, it does pay, you know, 8% dividend right now, and if the price drops, that dividend is actually, like, let's say it's at $40, that dividend is it's 10%. If it's like 35, the dividend is almost 12%. So yeah, that's a good thing, but you gotta wait for a better entry point. Okay, again, the shares outstanding going down. Let's take a quick look at their net profit margin. So it's also declining significantly. However, you know, like it was super high over here post-COVID, and that's not normal for this company. It's all over the place. So I guess the stable rate for that is around 10 to 15%. So that's not bad. Gross profit margin, you know, see typical is around 62%. And overall it's growing. Like, I don't know what's going on over here. Probably our data supplier shows that it's 100% over here. That's impossible, but the average is around 60% and it's growing, so that's a good sign. P ratio climbing, that's not very good. You know, here it was like 4 or 5, and now it's at 10. So that means that your price is actually increasing, and the stock is overpriced based on the historic, and their historic metric. Like even before COVID, you see PE of like 6, 5. So now 10 is kind of elevated. I would definitely wait for this company to go down a little bit and maybe start reaccumulating. So I promised you to compare this stock OMF to S&P 500, and here it is. We compare it versus SPY, which is a S&P 500 ETF. It tracks the 500 biggest companies traded in US. So if you invested 10 grand into this company 10 years ago, you would be sitting on 300% return versus SPY returning 227% in the same time, and that includes dividends reinvested. Without dividends, it is also pretty good return, as we said, 230%. Anyway, so yeah, you can see the volatility of OMF. It's like all over the place. So it's a great stock actually to sell covered call options. Basically buy it when it's cheap, then wait a few months. It usually comes up. Take a look at the price chart. We gotta go back here for the price chart, just on the OMF. So buy it when it's cheap, wait a few months, sell a cover call, then it drops. You can either purchase cover call, so you can basically wheel this stock to make additional income from the covered calls, and also 8 to 10% dividend. Alright guys, thanks for watching. This was once again Leo with DRIPCalc.com, and we just recently released this stock research platform. So we're running a special promotion, 30% off lifetime if you sign up. So the promo code is going to be in the description below, and you get access to all these great metrics, and also you can compare different stocks, so you also get access to this comparison platform. Okay, so if you compare, let's say Coca-Cola, Warren Buffett stock, he loves Coca-Cola, and it's doing well. It's up today. However, not doing as good as OMF. So OMF had basically like almost three times better performance in the last 10 years. And over here you can see they just raised their dividend by 4%, and their 5-year dividend increase is 32%. But you got to take into account the special dividend, so it's actually not very accurate. It's not a great CAGR tool, because you have to look at it basically compares this against that. So let's compare this OMF to Coca-Cola. Warren Buffett stock, he loves it, and he's been collecting a lot of money, a lot of dividends from Coca-Cola. But if you look at the performance, yeah, OMF is doing a lot better on the total performance, plus 300% versus 113% for Coca-Cola. Dividends growing significantly, much higher dividend yield than Coca-Cola. By the way, if you look over here, the Coca-Cola dividend yield is pretty flat, so it's not growing at all. Now they're increasing the dividend, but the yield is growing basically at the same pace as share price. So when's a good time to invest in Coke? When it drops to like $50. So yeah, by the way, this is our stock comparison tool, where you can see side by side detailed reports for each company. So over here, the dividend payout for OMF and Coca-Cola. Here's the dividend to free cash flow yield or ratio, share price for each, EPS and price to earnings ratio for each company. Okay, free cash flow to free cash flow per share, EPS to free cash flow per share, also free cash flow to stock-based compensation, net income versus revenue, cash versus debt, revenue. So all the important metrics we cover here. And we just recently released the stock research tool, and so we're running a 30% promotion lifetime. So if you sign up today, this is not going to last forever, but if you sign up with a coupon, we're going to put the coupon in the description for this video, as well as the pinned comment. You will get 30% off for life. Okay guys, thanks for watching, and I'll see you in the next video.